next part of the show, I'd like to introduce you to Richard Pindar, who is CEO and co-founder of Literacy Capital. And hi, Richard.
Good morning. Can you hear me?
Hi. Sorry, a few tech issues there. How are you?
I'm good. How are you?
Good. Thank you for joining us today. Yeah, so obviously you've had a very busy few months at Literacy Capital. Can you just talk us through, to anyone who doesn't know the trust, who you are and what you do?
Yeah, sure. So yeah, we have had a busy few months. We originally set ourselves up actually in 2017, September 2017. And as you alluded to, we listed in June. And so the strategy has not really changed. It's kind of been business as usual. But yeah, there's been that additional work stream, should we say, that we completed on the 25th of June. And since then we've been listed on the main market, the specialist fund segment on the London Stock Exchange. Shall I just give you a few of the key highlights and give you a bit more background?
Yeah, that would be great. Thank you.
Yeah, no, I mean, what we invest in is private businesses across the UK. Initially, when we set ourselves up, we raised £54 million. And we originally wanted to be private because completing the types of investments that we want to do is relatively hard, and you need to be relatively patient in order to invest the money in a sensible and prudent way. It's quite easy to raise a lot of money or raise too much money and then become feel under pressure to then actually deploy it, and more easy to obviously invest in the public equity side of things, but to invest sensibly in private businesses where they need quite a lot of work, and the amounts of money that the businesses need is relatively small. And so we wanted to do it without the pressure, I guess, and the gaze initially from the public market. So that's exactly what we did. As I said, we focus on private businesses. A lot of them, the kind of size range that we talk about is 1 to 5 million EBITDA. There's a few businesses that sit outside of that where we can be, again, pragmatic and flexible about the types of opportunities that we look at. We wanted to set ourselves up quite differently for a few different reasons from traditional private equity funds. In reality, what we do is quite similar to the private equity model or the buyout model, but the typical private equity fund structure we felt didn't really suit what we wanted to do. We wanted to be able to be more flexible, longer term holders of businesses, to really allow the benefits of longer term ownership, investment in those businesses to really come through, and having a 3 to 5 year time horizon that private equity funds have to adhere to didn't really work for us. And so we went down effectively the evergreen or the permanent capital type structure that we've got, and the investment trust structure that we've gone for. And I guess unusually we do have a relatively unusual fund or rather fee structure. And so, we charge a 0.9% management fee, which, for the kind of private assets is relatively low. There is an additional 0.9%, which we actually donate to charity every year, which again is, I'd say, almost a unique feature, certainly highly unusual within the private equity market, which, I don't think there's any peers that do something similar. I guess the only similar fund or investment company could be something like a Syncona, where I think originally it was founded as Battle Against Cancer Investment Trust, and it gives away a proportion of net assets every year to, more high risk cancer research or even donations to cancer charities. And so again, that was an important feature of what we wanted to set up. Again, unusually, because we're significant shareholders ourselves, so about half of the trust is owned by myself and other investment team members, and Paul, my father, who I set Literacy Capital up with, and other family members. We have no carried interest and we have no performance fees, because again, half of that, if we were to pay it, would end up being paid by ourselves. And so we kind of felt, well, actually our primary focus here, and the key financial incentive for us, is to deliver good growth for shareholders, rather than trying to effectively grow AUM inorganically or issuing new shares just to increase management fee. Our financial incentive will always be focused on doing what's best for shareholders. And as I alluded to, because of the permanent nature of the fund and the growth that we've got, the donations, therefore, because it's linked to net assets, has grown over a period of time. So, the total amount that we've managed to donate to literacy charities at the end of Q3 now amounts to just over 2.9 million, almost £3 million. And in the most recent quarter, so ending Q3, the total donation for the first time just exceeded £500,000. And if we can continue to grow, then obviously the donations and the impact we can have to support literacy charities will grow proportionately. And as we kind of touched on, we originally floated and listed on the specialist fund segment on the 25th of June. The market cap then was £96 million, which was also the last reported net asset value that we'd actually announced at the end of Q1. And we announced yesterday actually that Q3 net assets had increased in the quarter by 34% and had reached 147.2 million. So, good growth since the listing. And the share price performance has been very good as well. So I think the share price when we listed was £1.60. The share price today is about £3. So, in a relatively short period of time, shareholders since the listing have done pretty well. If you want to just turn over to the next page, I'll give you a little bit more background on the types of investments that we actually look to make. So, as I alluded to, UK-based businesses, privately owned, relatively small, but mostly cash generative and profitable businesses, can be a wide range of sectors. So we'll look at most sectors. There are some sectors we don't like, and there are some sectors just from a financial perspective or cash flow perspective we just think are not of sufficient quality. We prefer businesses that generate good margins and convert a high proportion of those profits that they generate into cash. So we're fairly, I'd say, old school investors or traditional investors in that sense, rather than looking at something that's higher growth or overly sexy. We'll look at doing majority deals. We will also do minority deals, and we will back existing management teams, or we will also help to build management teams within businesses that we think are sufficiently good but don't have they don't have complete teams in place. And so I'll touch on that a bit later on. But we're quite happy to look at businesses where they've got good tailwinds or they've got good growth. They're fundamentally good businesses, but they might have something missing in terms of no CFO. They might have a CEO that is approaching retirement age. They might be overly reliant on that one CEO, and so we need to build out a proper team around them. It might be a sales director, an ops director. It might be a non-exec chairman who can provide some additional support. And we're more than happy to kind of fill those gaps in the management team of the businesses that we back. We unusually, again, compared to private equity, we quite deliberately use relatively low amounts of leverage. And as the slide there alludes to, about 1 or 1.5 times of EBITDA. We do that for a few reasons. One, we don't want to lose money. We don't want to endanger the companies that we invest in. Quite often the businesses that we invest in need investment. They have to make these hires, and these hires for small businesses can be quite expensive proportionately. And so we want to give them the freedom to make those hires and make the investments that they need to make without having tight financial covenants in place with lenders. And so they have real flexibility to go and invest in growth rather than worrying about their capital structure. And so as a result of that, the leverage we have across the portfolio is very low. The types of situations that we like are, vendors. Often they've never sold a business before, and a key thing for them is they've typically set the business up themselves. They've worked with the employees and the management team for a long, long time, and having confidence in the capability and trusting the buyer is hugely important to them. And so for them, it's not purely a financial transaction. It's quite an emotional process as well. It's them often stepping away from a business that they've set up 10, 20, 30 years ago, and they want to find a good home for their business. And so, we're able to demonstrate that in a number of ways. the low leverage, the fact that, you know, all of the businesses we've got in the family today all have more employees and more revenue than they did at the point we invested. And so we can say, and we can evidence, you know, we do know what we're doing, and we can be a good home. The permanent capital side is really important in some instances. The uncertainty that, you know, a 3 to 5 year holding period can bring for some of the vendors is unappealing. And, you know, to then worry about, well, are we going to be sold to a bigger corporate, or are we going to, you know, be passed on to the next fund, and then the next fund, is something that just doesn't appeal to them. And so, you know, we like to find businesses where we have a good relationship quite quickly with the vendors. What they want and what we want is strongly aligned. They want to invest in the business. There's good opportunities to invest in the business. And as a result, you know, we tend to avoid larger sale processes where they become very over-engineered. They can become very competitive, and you can burn quite a lot of time involving yourself in those processes. You know, we've got a small team, a team of 7, and we've completed a large number of deals, you know, relative to, you know, what private equity funds would expect to do for teams of our size. And, you know, one way we're able to do that is by having very straightforward conversations about what we can do and what we can't do. And, you know, people really like that approach. And so, you know, we're able to transact much more swiftly than other funds can. And as I touched on, you know, many small businesses have, you know, over-reliance often on too few people, on the founders most typically. And so, you know, we realize that, you know, just because there's not a complete team there, that's not a reason necessarily to pass on the business. And we're more than happy to supplement the management teams with additional talent. And quite often we're able to bring in talent that, you know, these businesses on their own, when they're privately owned, would probably not want to hire because of how they would perceive the cost, and also in reality probably not be able to hire. It's quite a hard sell to bring in somebody that's worked in, you know, maybe a more corporate environment, a more professional environment, to take the step down into something that's privately owned. But by having an investor on board that can kind of paint the picture of what things can look like in the future, helps to bring in a, you know, slightly higher level of ambition and excitement, which can be quite helpful to bringing people on board. And so, as the final bullet there alludes to, we've completed 17 platform investments plus bolt-ons, and we've added somewhere in the region of 35 to 40 people at a board level to the companies that we've invested in. And by bringing in people, incentivizing them in a different way, in a, you know, in an aligned way to what we want to achieve, you know, we can help to really accelerate growth in those businesses, which, you know, helps to create value for everybody. And so, yeah, we focus on the smaller end of the effectively kind of private equity buyout end of the market. Things in that end of the market tend to be less competitive. You know, there's lots of talk at the moment about huge amounts of dry powder in the private equity industry, but that tends to go to the bigger funds where, you know, smaller businesses like the ones we want to focus on just are too small. It just doesn't make sense for them to invest in businesses of the size that we look at. And so, you know, as the private equity market gets bigger, it's becoming more congested, I would say, for looking at businesses larger than the businesses we look at. And so, you know, we think we've got a good competitive positioning where we sit at the moment.
Brilliant. Thank you. Shall we start some Q&A? We've already got some questions coming in.
Okay, yep, definitely.
Sort of go back and forth to the slides. So you talked, obviously you sit in the private equity sector, and you talked about how different you are. I don't think there is another trust like yourselves, but is there anyone that you would consider as a competitor, like that you do compare yourselves to?
I guess in terms of competing, we would, you know, there are occasionally other funds, private funds, that we would have, you know, that would be looking at the same businesses that we would look at. And so, but at the smaller end, there's in all honesty, not very many. And funds that tend to have success, their financial incentive then is to raise a much bigger fund next time round, because their financial incentive is to generate or charge 1.5 or 2% on the fund that they're managing. And so for good managers of private capital, they tend to promote themselves into a big, you know, the next tier each time they raise a fund. And so, there's not really competition that I would say is enduring or sustained, and so it tends to be quite ad hoc when we do see competition. Yeah. And often our competition can be maybe VCT funds in some instances, albeit they're kind of falling away because the rules become increasingly difficult to comply with. Yeah. And also it takes such a long time for them to get tax clearance. Again, that's quite a turn off when they're having to deal with vendors and say, well, we can't do anything for 16 weeks. And, we can from start to finish get things done in 4 to 6 weeks. In terms of, I guess, peers, I mean, there's obviously a few trusts that invest in private assets. I guess there's, EP special opportunities. But again, I think our approach is quite different, that they're a lot more concentrated. They've got fewer assets than we do. We tend to do much smaller investments than they do. Yeah. And so, yeah, I would expect the returns we would make and they would look to make are quite different. As I mentioned, there's Syncona that has the charitable element that we've got. There's, I guess, Caledonia that has a kind of family dynamic that we've got in our IT capital. So I guess we're almost a bit of a blend of a variety of different, different features that other trusts have. But as you say, I don't think there's another company out there that ticks all of the boxes that we've got.
Sure. And how do you mitigate risk with such small unlisted firms?
Yeah, it's a good question. I mean, given the investments we do, one of the key questions we say is, what has to happen here, or what has to happen here for us to lose money? And, I guess there's a few things. Firstly, we try to invest in businesses, even if they are small, that we think are fundamentally robust, or, don't have things that are outside of their own control to achieve success. And so, we've obviously had a little bit of luck on the way as well, because, there's always going to be recessions or things that come up that impact businesses. I don't think COVID 2 years ago was kind of, or a pandemic was top of our thinking. But that said, all of the businesses we've got largely have traded through that period well. And I would say that's down to two things. One is, I guess, quality of the business. We've always tried to ensure the businesses we invest in are of at least good quality or very good quality. But also, secondly, the quality of management in smaller businesses is extremely important. And, it's one of the reasons why we focus on the smaller end of the market is, in many smaller businesses, they've been family owned for so long. They've never gone through a period of professionalization. They've never had external shareholders before. They've not had that external perspective. And, by bringing in that kind of experience and the learnings we've had from elsewhere, it does mean there's often quite a lot of low-hanging fruit. And often, again, the people that we can bring in from a slightly more experienced background and a slightly more corporate background, they're often able to have quite a significant impact on those smaller businesses quite swiftly. And so, through, I guess, good businesses and good management and being able to, make sure that the managers we've got in place are really, really good. And we're really pleased and, really proud of the management teams we've got. I think that's the key way really for us mitigating risk. And then also, risk in the capital structure. All of our businesses can afford to have bad periods because they're not really pushed from the debt side. And, they have, businesses of ours have had soft months, but as a result of that, they don't have the bank knocking on the door saying, well, we're looking at your management information and this doesn't look so good. So I think it's all of that combined, really, business quality, management quality, and then giving enough freedom and enough flexibility in the capital structure so that if things don't go completely to plan, we're not up against it.
Sure. Do you think you could talk about one of your holdings as an example? We've actually got a request to ask if you could maybe talk through one of the larger ones and its journey with you and how it's developed under management of literacy capital.
Yeah, no, sure. I mean, I'll pick the top one because it's obviously then therefore the most meaningful, and it's a good case study as well and quite typical for the type of business we might see. If you just want to go over one page, there you go, Grace. So Grace, as you can see there, at the end of September was valued almost at £32 million. We originally invested £2.1 million into that business, which is disclosed in the prospectus. As you can see on that table, we originally invested in it in July 2018. It was a relatively small business back then. It was making, call it 1.5 million of EBITDA or so. It was being run by a husband and wife team. The wife no longer wanted to be involved in the business, and so a lean management team of 2 became, an unmanageable 1. As a result of that, Peter decided that he was thinking about selling the business. Initially, he thought about selling the business to trade because, the thinking was private equity are not going to support the buyout of business when the management team is effectively one person, one senior person within it. And we effectively said to the 2 owners, we said, well, actually, we can do a deal here that gives you what you need in terms of the financial outcome that you want. You can sell stakes in the business. We can also help you to build the team. And so actually the fact that you've not got a complete team is not a concern for us. We've got people on our bench that are ready to go that we can kind of effectively drop into this business to help take it on. And also, crucially, you can retain a minority shareholding in this business, which if you sell this business lock, stock and barrel to trade, you won't be able to share in the upside that we think we can help to generate within this business. And so that's what we did. The business itself is very similar, I guess, to a business you may be aware of called FDM. So it effectively takes graduates from universities, it trains them, they go through the recruitment process, they then get trained, they get paid through their training, which is a feature that is different to FDM. We treat the graduates really, really well. They get good training, and then they're deployed effectively on projects with, big names. So, big names that Grace have got as clients would be AstraZeneca, RBS, WorldPay, clients like that, that effectively use Grace to as an outsourced graduate recruitment program. So they don't actually have to manage that process themselves, and they can rely on a specialist third party to manage that process for them, and also to manage any specific projects where they need specific skills. They can have the people that Grace can provide to temporarily increase the capacity that they've got internally. And so that business, when we invested, had probably 120, 130 people in it. Currently has about 600 chargeable analysts in it. Almost all of that growth is completely organic. We acquired one small business which had about 40 heads in, but the rest of it is organic. To illustrate some of the change that we've done there, we've appointed a new non-exec chairman who is actually also a non-exec director of Literacy Capital. He was, by his background, his kind of primary role before Literacy Capital, he was the head of sales at Capita, and so very well used to dealing with the types of clients that Grace wants to sell to. We've also since added a new CEO that joined in January 20 when the founder wanted to step down and retire. We brought in a new CFO, again, really good CFO, a guy called Paul Jezard. We brought in a new sales director, and we've also in January got a new COO joining that business. And so, quite swiftly, we've managed to take a business that had been flat for several years. It had been a lifestyle business effectively, hadn't been growing significantly or quickly. And we've managed to grow that business really, really strongly. And you can see the value there that's been created from a £2.1 million investment to one today that's worth about 32 million. And we've also, in addition to that, had cash back from that business that we can now redeploy into other businesses. So that's the type of business where family owned. There's some initiatives that we can do, and some building out of the team that means it's less reliant on certain individuals, and we can really help to put the foot on the accelerator regarding growth, and really help accelerate the growth and the ambition within those businesses. Some really good people in that business, and a large number of them are still there today, but they just needed a bit more help and a bit more support, which we've been able to bring. So that's been obviously a success story for us, and RCI is a very similar story. 4 founders rather than 2, but again, we've completely rebuilt the management team there as well. New CEO, new CFO, new sales director, new business development director, and new ops director. And so similar themes throughout many of the businesses that we've helped to build value in.
Just on Grace again, it's the largest holding at 21.6%. at what level would it start to get too big from a risk perspective? And how would you go about diversifying the holding should it continue to grow at such fantastic rates?
Yeah, it's a good question. I mean, it's obviously something that we talk about. I guess at the moment, there's two ways of looking at it. One, you can view it as, I guess, a risk, but I guess the other thing also is we view it as a huge plus because, you know, we own over 60% of the company. We've selected the management team. You know, we have a huge degree of information about how the business is trading, and a huge degree of you know, influence in how the business moves forward. You know, much more than we would if we were invested in a you know, publicly listed business. And so, whilst it's obviously a risk, there's also the positive that we do have such exposure to a business that we've got such a strong amount of control and influence over, and we do know that it's growing so strongly. You can see some of the growth metrics there on the right hand side of the page, and you know, the most recent fact sheet alluded to both the top two holdings, which are disproportionately large, growing even more quickly than that figure there. And so, you know, it is a risk, but actually if those two continue to grow, they will continue to generate outsized returns for us as well. So it's a slight double-edged sword. But to answer your second part of your question, what could we do if it does get disproportionately big? You know, we could do something similar to what we did with Yfinity back in Q3. So for Yfinity, we effectively had an interest in a business, and there were some shareholders that wanted to sell, and so we went through a transaction bringing in a new private equity investor that bought a majority stake in the business. And in that instance, we effectively rolled the proceeds from the transaction into the new into the new transaction structure. And so we could do something similar with Grace if we wanted to, where if we wanted to realize some cash out, we could go through a secondary private equity process if we wish to, where we could choose to roll probably not 100%, probably, you know, 30, 50% of our holding, and effectively then continue on the journey and realize, you know, a considerable amount of cash, but also keep a considerable stake in the business going forwards. The other thing we've talked about with Grace is similar to FTM, you know, the peer that I mentioned earlier. We could also list the business like they did, I think, back in 2016. And so, you know, we could then take the view at an IPO, how much of this stake do we want to keep? How much do we want to realize? And so, again, slightly differently to private equity, we do like the IPO option. We will look at the IPO option. And it does mean we can retain, you know, a significant shareholding in a business that we like, in a management team that we like, and we've probably helped to create. And it just means we can remain, you know, we can then realize that investment and drip it into the market over a period of time if we want to then redeploy that value into something else.
Brilliant. And what is your average holding period?
It will tend to be a bit longer, I would say, than normal private equity. And we don't tend to kind of dictate to our businesses or the management teams as to how long we want to own businesses for. We would rather be led by them. And so, you know, there are some businesses where, you know, we've invested in, and the owner of that business or the CEO of that business has said, I want to do this for 3 years, and then I want to list the business, or I want to sell it for as much as I can. And we're entirely supportive of that if that's what they want to do. Equally, you know, we've got two businesses we've invested in recently. One of them there, Vanilla, that's mentioned, that are run by the son of the founder. And so they're family businesses. And, you know, again, a key thing for them was, you know, that they've been in the business for a long time, the people running it. They don't really want to go and do anything else. They want to have the independence that they've got as with the structure that we've given them. And so I wouldn't be amazed if either Vanilla or TireFix, the other business I'm talking about, where the CEO there, you know, wants to be there maybe much longer. And if he does want to be there much longer and it's growing at the rate that is, you know, we're very happy with, then it wouldn't make sense for us to, you know, sell the business to somebody else just because our fund structure compels us to. And so, yeah, we can be very flexible. We can own things for, if we want to sell something after a week, a year, a month, you know, whatever it is, we'll be open to selling if it makes sense. And that's what the management team wants to do. I think the reality is we're likely to be longer term holders, because, you know, when we do get things right and the businesses start to mature, and so you can see some of our bigger holdings are businesses that we've owned for, you know, several years now, because it takes some time to get the growth into those businesses, to get the to get the management teams right. And so we don't want to sell those businesses prematurely and allow other people to benefit from the growth. We'd much rather, our shareholders benefit from that rather than selling prematurely.
Oh, thank you. We've got quite a few questions about the premium. I'm just looking today, it's currently at 20.41%, but I think it went as high as the high 40s last month. Can you talk a bit about the premium, and are you comfortable with the shares trading at that level?
Yeah, I guess a few comments. I mean, it's quite different. I think when the premium went as high as it did, it was obviously based on, at that point, quite an old net asset value figure. And so, we did make several RNS announcements that I think that, again, that are referenced on that page there, where we had informed the market that there had been transactions at a significant premium to the carrying value. And so I guess that helps to explain some of the uplift and the kind of, the premium that was there. I guess also, if you look at two things, if I speak generally rather than about us, I guess if you're a medium to long-term investor and you've got good growth in the underlying assets, and you've also got confidence in the valuations, then, I think paying a premium can make sense. And so, as long as we can continue growing NAV and we can continue to demonstrate that our valuations are reasonable or conservative, then, hopefully the premium can be sustained. And I guess also, Paul, that I mentioned at the start, his background is he was one of the founders of Capita. If you were to ask him that question, he would say when he listed Capita, when the market cap was £8 million in 1989, he was told by fund managers then that it was too expensive, and he was told by fund managers consistently over the next 25 years that he was too expensive. But over the period that he was there, Capita generated over 400 times their money for the individuals that invested, or the investors that invested at the IPO. And so, I think, as long as the performance is good and, people are not going to trade too frequently, then, I think that's just the way that things are at the moment. I don't know if that's always going to be the case. But again, we don't plan to issue more equity. And so there's not going to be floods of equity or new shares coming onto the market, because, again, our incentive here is not to grow the fund to charge fees. We want to grow the fund as safely and as quickly we can organically. And, we're financially driven to do the right thing for shareholders. So, yeah, there's no plan to issue more shares to take advantage of the premium like other funds might want to do. So, yeah, it's a slightly different dynamic, I would say. And also it is quite tightly held. The free float isn't massive. And so, just this issue of supply and demand is one that I suspect that the premium is going to persist for a period of time until we become, I guess, larger, or some of the earlier investors want to sell. So, yeah, it's obviously something we keep an eye on, but I don't think there's too much at the moment that we can do about it.
Sure. And a bit of a broad question here. What are the main things that you worry about? What could interrupt this tremendous performance that you've seen so far?
That's a good question. What do I worry about? I guess a worry always is where to the next, pipeline and kind of new investment opportunities. What I'm quite pleased with is the quality of the investments we've made so far have been generally really good. And we've priced them well, and we've structured those investments well, and to ensure that we keep that quality threshold. And so always looking out as to, where the new engines of growth are going to be. That's obviously key, and to just keep NAV moving forwards. I guess I don't have too many concerns about the portfolio at the moment. I mean, there's some maybe smaller holdings that have been maybe indirectly impacted by COVID and supply chain issues, which is obviously getting huge coverage at the moment in the media. And so I'd say there's some sort of small concerns around how those companies can deal with those issues. But, amongst our biggest businesses, as the commentary in our recent fact sheet alluded to, the growth's really strong. The the capital structures give them huge freedom. There's not onerous amounts of debt within those businesses. So at the moment, Touchwood, generally relatively worry-free, I would say.
Brilliant. Are you worried at all about rising inflation?
I guess it's an interesting question, and it's probably one a lot of fund managers can think about when they're investing in, when they're investing on a kind of theme basis, should we say, or a kind of more macro basis. I guess we would think about it, and how could inflation or the supply issues that I talked about before impact the financials or the operations of a smaller business. So if I speak with specifics, we've got one business that's not listed on this page, a business called Alufold, that builds or creates aluminium door and window frames for nice high-end properties that are being redeveloped or are being extended most often. And one of the issues they've had is aluminium prices have gone through the roof, and also getting aluminium into the country, given what's been going on, has been increasingly difficult. And so then the question from our perspective is, well, what does that mean in terms of gross margins? How can we pass those cost increases to customers? Will customers accept those price increases? Are we going to be able to get hold of the stock that we need to be able to service the demand that we've got? Demand's really high at the moment for home improvements because people want to make their house more suitable for working from home and things like that. So that's been a big driver for demand for them. And so I would say generally not hugely worried about inflation, to answer your specific question. However, there are some sectors at the moment that are feeling the pinch more, particularly if they're less able to pass on cost inflation to customers. So that's a key consideration for us. And also, I guess on the inflationary side, again, being able to get actually hold of the stock that they need, and what the specific issues are with their suppliers, which I think for some of our businesses now are easing, but have certainly been a concern during this year, in the earlier part of this year. Yeah.
Do you think that, so obviously we've had the pandemic, but then the UK has also faced issues with Brexit and etc. The UK clearly has been on love for quite a while now. Do you think that's starting to change?
I think so. I mean, if you look at the level of activity from a M&A perspective, involving public companies and private companies, there's certainly been a strong uptick. Valuations are across the board, I would say, are pretty good at the moment, or pretty strong. So yeah, I think it's interesting as well, because there's always a lot of talk about transaction volumes, but in all honesty, a lot of the deals that we do are not really driven by those types of macro themes. They're more driven by personal circumstance. They might be driven by quite human factors like death amongst shareholder groups, or divorce, or retirement, or shareholders within private businesses wanting different things. And so regardless of what's going on in the UK, those human things are death and divorce and retirement. They're never going to change. And so there's always going to be an underlying level of M&A. And as long as we focus on the requisite quality of business, then almost some of the stuff just becomes sort of noise in the background, hopefully. So yeah, not too concerned about the state of the UK at the moment, and I think generally the signs are probably improving, and the level of interest in the UK, again, particularly given the froth in other, particularly the Americas, I think there is certainly more interest, and there is noticeable interest, I would say, from overseas as well. So yeah, generally pretty positive on it, I would say.
Sure, thank you. Just had a question in. Where do you get your ideas from?
Ideas as in new businesses?
Yeah, leads.
Leads. It's a good question. All sorts of different avenues, I would say. So there's obviously a network of corporate finance advisors out there. They effectively act as intermediaries, or the equivalent of an estate agent. So we'll have an effort to speak to advisors all over the country to make sure that they know of the types of businesses and the types of if we want a 4-bed house in somewhere, then you go and speak to the estate agent in that area. And so we go and do the same thing. We try to say to them, look, if you do have any clients or even businesses that are not clients of yours that fit these different characteristics, we'd be delighted to hear about it. And we talk about, how straightforward we are and how swift we are to get transactions done, which, is not always the case in the private market. We speak to lots of people that maybe aren't, professional corporate finance advisors, but have reasons to see businesses. So, whether they're people we've worked with before, whether they're CEOs of businesses, they run businesses, they might see competitors or they might see other businesses in different spaces. Just chance conversations. It's kind of, the more conversations you have with, good people that might see relevant opportunities, the more opportunities come our way, I would say. So there's no real magic source or there's no real formula. It's just, you've got to kiss a lot of frogs, I would say.
Thank you. I'm conscious that we're getting to the end of our session, but have you got time for one more?
Yeah, absolutely.
Obviously, the charitable giving segment of the trust is a very important differentiator. So can you talk a bit more about that? And we've got a question asking, does your charity pledge give you an edge in attracting investments? And you've got a slide here as well on that.
Yeah, it's a good question. I mean, we set up Literacy Capital with the explicit charitable objective. And we didn't really expect there, if I'm honest, it to have a huge benefit to us. We kind of did it for the reasons of the UK has the lowest rates of childhood literacy of any kind of developed country in the world. And 200,000 kids leave, primary school every year unable to read, which is, quite shocking and has quite a significantly negative impact on those individuals and their families for the rest of their lives. Because if you can't read at 11, it's unlikely that you're going to catch up. There's a good chance that you won't complete secondary school. There's a good chance you'll end up in prison, or disproportionate chance you'll end up in prison, because often you have fewer. Your option is nick stuff or don't eat. It's almost as stark as that. And so we wanted to set up Literacy Capital to provide consistent income streams to charities to allow them to plan. And so we actually set up a charity called Bookmark. Paul's wife Sharon is the chair of that charity, and we wanted to make sure that they scaled swiftly and they delivered the reading programs that they deliver to struggling and disadvantaged children, that they do one-on-one, both face-to-face and online, in a cost-effective way, and they could scale at the rate that we wanted to. And so that was kind of the purpose for setting up literacy in the way that we did. And as you can see there, we've donated almost £3 million, which for a fund of our size, having only raised 54 million, is quite a considerable amount. But what we didn't anticipate is, as I said, a lot of the people we deal with have never sold a business before. They do view the business as one of their children or as their baby, and they want it to go to a home that they're proud of and they like. And actually, the charitable objective does help to demonstrate that we are very different to private equity. We're not just doing this to make money. We're not just doing it to treat a business as an asset to buy and sell. We're doing this for a broader purpose, and we do genuinely want to help them build their business, and we want them to help it become much more successful. And the more successful it becomes, the better for NAV and shareholders, but also the better for the charity, because any uplifts in the value of that asset then contribute to bigger charitable donations. And actually that message in certain transactions has landed extremely well. And to the extent that it then becomes less of a conversation about price, and these people are going to walk away with many millions of pounds, and the last £1 or £2 doesn't make the biggest difference to them. What really makes the biggest difference is being able to bump into their former colleague or in the local pub that they want to continue going to, and they want to be able to look them in the eye and say, I've done the right thing for the employee base and the local community and things like that. And to have the charitable objective really helps to support that. So yeah, it's a very good question, and it is something that we've increasingly seen, that the fact that we do support a charity so significantly and so actively has helped us in completing transactions.
Brilliant, thank you. Yeah, a really commendable element to the trust, something that really is different to anything else that we've got out there. Well, we've gone past 12 now, sorry we've overrun a little bit. But thank you so much for your time. Really great having you on the show today. I'm sure we'll do plenty more things like this again. And thank you to everyone that joined in today. As you can see, we've got, wait till I get there. We've got some more events lined up, including our ESG webinar, which is taking place on the 16th, 17th and 18th of November. And we have Natalie Kenway from ESG Clarity opening that for us. So please tune in next week where we'll have Rory Bateman from Schroeder British Opportunities. And thank you again for joining. Thanks, Richard.
Thank you very much. Thanks, Jana.